SBA loan default rates have surged in the post-COVID era, going from $570 million in 2021 all the way to $1.6 billion, okay, in 2024. Early defaults, meaning, the first 18 months after acquisition, have nearly tripled. What does this mean for investors and acquisition entrepreneurs? We're going to get into that. In this video, we're going to talk about what the current SBA default rates mean for the market today. We're going to talk about why some businesses fail while others thrive, and we're going to discuss 3 rules to buy smart and avoid common mistakes that business buyers make. My name is Walker Dybel. I am the Wall Street Journal bestselling author of Buy Then Build and creator of Acquisition Lab. We all remember that during COVID, the stock market crashed, the Fed lowered interest rates, and printed a stimulus check for everybody. So many of these businesses, whether they realized it or not, they were sort of dependent on cheap capital. Post-COVID, default rates on loans has become a headline. Like, we all are aware of real estate deals that have defaulted because of the increase in interest rates. The same thing has happened with the SBA 7A loan program, which is commonly used for business acquisitions, partially used by me since 2006. So what's going on here? Many businesses were simply over-leveraged. During the low interest rate era, they took on more debt than they could handle when things changed, and that's the situation they're in. Raising defaults signal distress, sure, but they also signal opportunity because the best buyers capitalize when others panic. So let's discuss why some businesses struggle in a downturn while others thrive, okay? And first and foremost, I want you to understand that trying to do well in a downturn isn't always trying to maximize, your exit. There's sort of different strategies, but let's get into this. So ultimately, first and foremost, the thing I always want to look at are the margins comfortable, right? If you have a low margin business, it's just so much harder to survive. We had someone in the acquisition lab who, wanted to buy a sandwich shop, I think. It was not a chain or anything like that, but it was one of these where the bottom line net margins were like 2% after you took into consideration the principal and interest. And my advice was, do not buy this company. And, unfortunately he did. It didn't work out well for him. There just wasn't enough room. So you have to have appropriate margins to be able to survive volatility in top line revenue, okay? Second is going to be high fixed costs, right? So I'm always looking at, is this business labor intensive? Is it capital intensive? How much overhead is required? In a lot of my companies, whenever I can, I always hire freelancers because it's one of those where, first of all, there's less overhead if you're just paying them the salary and you're not paying them, benefits and, everything else that comes with that. And then second is, in the event of a downturn, you can always let go of a freelancer, right? You just need to be careful and make sure that you're not replacing employees with freelancers, okay? Third is going to be that cash conversion cycle. And what this means is every single time you have to outlay money to buy inventory and then, produce whatever you're producing and selling it, and then, that receivable gets paid. It's that amount of time. I almost bought a business, but then didn't when I realized the company needed additional funding every single time they got an order because the cash conversion cycle was so long, they were losing money on the whole order, and they couldn't quite figure out why they were struggling. And it was a very attractive business. It just ultimately the numbers didn't work, right? So even though they had, comfortable margins, the cash conversion cycle, the amount of time the cash was outlaid was just something that was so brutal, it made the company struggle. Lastly is going to be companies with, supply chain vulnerability. If you can't get product to sell to, your customers, then obviously you can't move revenue through your business, okay? These are the main reasons why companies really struggle with volatility in the markets. Okay, now let's flip it around and talk about what makes companies thrive, okay, in, turbulent waters. First and foremost is going to be sort of like essential businesses, right? So, I was on the phone last night with my good friend Tom Stribe, who has spent the last 20 years building, Stribe Electric here in St. Louis. Look, I probably shouldn't be saying this on YouTube. The guy can't stop getting unsolicited offers for his business. Tom, when he was in his young 20s, was up on the roof with his uncle, who is a roofer. And he was like, yeah, I want to get in the trades. I want to be a roofer. And he said his uncle almost pushed him off the roof and said, nephew, if you want to be in the trades, I get it, but do not be a roofer. Go be an electrician. That's where all the profits are, right? So I know we're all going frantic over HVAC at the moment, but it's, there's a very equal opportunity in electric right now, residential electric. And it's one of those things where, it's always going to be there every single month. There's going to be demand. Okay. Probably a little bit more in HVAC, but electricity and power is always in demand and always going to be needed. Your margins have got to be high because the only cost of goods sold is going to be direct labor on a job. job. So as long as you can manage it right, okay, you're going to have very little percentage of revenue be an actual product or material. Next is going to be recurring revenue models. This is, if you go over to the AE matrix, it's that eternally profitable quadrant that we talk about. A lot of times in that eternally profitable quadrant, you can sort of get into these recurring revenue models as well. So imagine Hoffman Brothers, also here in St. Louis, that is an HVAC company. What they did was they took their HVAC company and they turned everybody into members. I was resistant at first. My wife was like, no way am I sending you money every single month. But then when I just did the math in terms of what filters are going to cost and the fact that they were proactive and all the rest of it, I went ahead and signed up. Chris Hoffman, he's on Twitter. I pay him every single month. And they come to my house. They're at my house this morning. They're changing out the filters and they're telling me everything that's broken and how much money I got to give them. It's a great way to get into potential customers' houses and sell them new things. All the while I'm paying them every single month. And so that recurring revenue model is really hard to get out of. You see a lot of it in SaaS businesses. I have another friend who has owned a SaaS company that basically they stopped working on, 19 years ago. No kidding. 15 years ago, he still gets money just into the bank account. He doesn't shut it down because it's on auto payment on people's credit cards. That's the power of recurring revenue. It's also going to be companies that adopt to the new economy. I always say they've got one foot in the old economy, one foot in the new economy. So if you look at Apple, it's not a phone company, right? We all know that. It's not a computer company, right? It's a software company. It's an internet company. We know this. You look at Tesla, it's not a car company. It's a software company. It's an Internet of Things company. So whenever you can bridge the gap between these two things and you can marry the new economy with the old, you're not susceptible to one or the other, right? You're not susceptible to becoming a legacy business or ancient history because you're relevant and new and current, but you're also not 100% new and current without any sort of tangible benefit. So the people that can actually spread across that chasm are going to be the ones that actually thrive in any of these markets. Lastly is going to be the ones that adopt to consumer behavior. I'll go out on a limb and share, my thoughts on Amazon. They've got one foot in the old economy, one foot in the new in terms of, they're really just a network of warehouses. But we think of them as just an e-commerce site where we can buy things and they magically appear in a day. They are pushing the buck in terms of what it means to adopt to consumer behavior and what is needed there. That's a perfect example of transforming to consumer behavior in order to thrive. So let's break down the 3 rules for buying in uncertain markets. Number 1, I want you to get the trends right. So I always talk about trends. I always try to explain that you need to buy something that's sort of on trend, but not trendy. Look at the long-term fundamentals, not short-term hype. Let me give you a brief example. Right after COVID, there was actually about 12 to 14 billion dollars that poured into buying Amazon FBA businesses, okay? It was a number of private equity backed firms that emerged to try to buy up all the brands. And ultimately what happened was that COVID pushed online ordering to new highs, okay? So a lot of these companies were growing 20% year over year. At the same time, you had a whole bunch, billions of private equity coming in and just pouring into too few businesses, which raised, valuations to sort of mid-market kind of levels, which the private equity firms didn't really mind. They were very comfortable with it. And they felt like even though it's a competitive market, they were able to actually still get comfortable because of, deferred comp and, equity roles and all the ways that they were structuring in middle market types of ways. But the thing was a lot of these companies were just too low to the ground. So when you go from, let's just say 1 million in revenue to 750,000 in revenue, it just can wipe you out, right? And so when that happens at scale, it's a nightmare. Okay, so a lot of those companies today do not exist. I'm not fully up to speed, but I think there's maybe 3 left that have acquired the other. They aggregated the aggregators. Number 2 is focus on intrinsic value. So when I bought my e-com business back in 2016, what I noticed was number 1, it was a reseller, which was out of style. It wasn't my own brand, but here's what was going on. In Europe, this was actually an old adopted comfortable technology that everyone knew about. And in America, it had only been here for a few years. It was macerating toilets, if you're dying to know. But ultimately, there was a real need in the upper Northeast. And so a lot of people were needing to pump water out of their basements with our pumps. And then all of a sudden, people started using them to build bathrooms in their basement. It's a 4-hour DIY install, all the rest of it. I'm not going to give you the sales pitch. The point is that it is a established, proven technology in Europe that solved a very specific problem. And it had been in the States for about 8 years when I bought the company. And every single year, awareness was growing, okay? What I also noticed was there was extremely limited distributors. And the manufacturer did something very smart, which is they really limited it to just a few people. And so as a result, I looked at everyone in the business. I looked at the manufacturer. I looked at the other resellers. No one, not a single person, had focused on search engine optimization. No one had focused on, keywords. No one had focused on backlinks. No one had focused on truly educational content that helped people make decisions about what they were going to do in their home. And so I saw an opportunity. I built the single largest search volume websites in the whole entire space. Okay. So, I looked for, in that industry, what drives value? Well, number one is going to be the brand. Well, I don't have the brand because I'm a reseller, but number two was going to be, can I own the highway at Google and, mass rating toilet so that we can, capture all the traffic and get them what they need. So ultimately, I'm always when I'm looking at every business, I think to myself, what's the intrinsic value here? Like, what's that real asset? And it can be goodwill as well. Third, look for what everyone else is missing. So the first thing I want you to look at is sort of like distressed businesses, right? Guys, I've been in so many deals and I've seen great companies that I've even brokered, okay, that are like, this is a great business with all of these great assets, but as soon as the revenue is going down, okay, if the seller is, just kind of not into it anymore or whatever, but has all these great assets, buyers don't want to touch it with a 10-foot pole. It's really hard to get comfortable. So, always look for businesses that just have a little bit of distress, a little bit something wrong, but something that you can bring value to. That's going to be the little thing that makes the big difference there. Next is going to be motivated sellers. So I had a lab member who was actually in St. Louis yesterday, and I got together with him. And the thing is he's 90. The seller that he found is 95 years old. Okay, one daughter doesn't want into the business. They're doing between 7 and 10 million in revenue, and it's one of these where the seller is just 95 years old. That's it. And he's not really money motivated. He's more like, who's going to take care of my people? Who's going to be, who's going to be able to carry my legacy? And he's motivated for different reasons. So I found that to be a really compelling story. Lastly is hidden assets. I had a business that I eventually acquired that had this sort of like DOS-like ordering system. And there was one person that had the big binder at every location that could order. And I was just like, wait, people are actually ordering, and like, I couldn't order on this if I tried. And he was like, yeah, we have these 70 customers or whatever. So I saw that as a hidden asset. And what I did was I acquired the company. I simply, plugged it into, WooCommerce and WordPress, and ultimately built an Amazon-like experience for businesses with multiple locations, right? And so we rolled it out to one of the largest privately held companies in the country. And then we were able to start bringing on additional customers as well. And that was simply because I saw the potential of an asset that they had that they weren't really capitalizing on in the right way. Didn't cost me much. I mean, it wasn't expensive software, right? It was just the ability to be scrappy and make it look pretty and make it do all the right things for the customers. SBA defaults signal a distressed market. But here's the big takeaway, okay? Distress creates buying opportunities for those that can correctly analyze risk. Listen, if you're interested in buying a business in the next 1 to 24 months, consider the Acquisition Lab. We've built the elite accelerator in this space to help people buy existing companies. Our members have acquired over $400 million in small business transactions. We've got world-class education. We've got a truly vetted community. We've got, all the resources, tools, and everything else you'll need to learn. We've got a cohort-based onboarding system, okay? We have service providers and everything else, and I've priced all of it, lifetime access, at less than 2 months of a buy-side advisor fee, okay? Check us out, acquisitionlab.com, and we'll see you on the inside.